It is very easy to write off the recent news about the Fed cutting interest rates as quote unquote Wall Street news. However, this news filters straight into your wallet and has an impact on your personal finances. So let's talk about it. Hi, I'm Chizaba, and this is Zaba's Wealth Lab, a space where we talk real world finance and encourage building wealth fearlessly. So, if you have or have not heard, the Federal Reserve just cut interest rates. And whether you are paying off debt, whether you have savings in CDs or a savings account, or you are just trying to make smart money moves, this actually impacts you directly. So, today let's talk about what a federal rate cut actually means and what it means for you, as well as the opportunities that exist within it and money moves you should be making right now. So, federal rate cuts occurs when the federal government lowers the national interest rate for your CDs or your mortgages or your savings accounts. They are all based or tied to what the national federal interest rate is. For example, for some of your credit cards or for those of us that have mortgages, you will hear or the prime interest rate plus something else, or the base interest rate plus something else. Whatever that base or prime is usually related to the federal interest rate. So the federal government can increase or decrease whatever that prime or base interest rate is for the entire country. And so recently this month, the Fed announced for the first time in a while that they are cutting or lowering rather the interest rates. And so, what does that actually mean for you? How does it affect you? It means lower borrowing costs. So, if you have a mortgage or you're planning to get a mortgage, there is the opportunity that exists that you are going to be getting that mortgage at a lower interest rate. So, where typically mortgages are, let's say for example, 6%, 7%, 8%, they can be lower right now depending on the area where you live. It also translates to personal loans like your car loans or your car notes and other personal loans you might have, like if you're going to get a payday loan or something. Interest rates might still be high, but they will be lower than normal because the base or the prime interest rates that is usually attached to all of that has to be reduced because the feds have cut or lowered interest rates. And the reason why they typically lower interest rates is because they're trying to increase spending, put some more cash, inject some cash into the economy. Now, on the flip side of that, if borrowing costs go down, it also affects savings, like your interest rates, your CDs. Unfortunately, the interest rates on those go down as well. I mean, with a regular savings account, it's not as if they're very high up there. Like the average interest rate for a savings account is less than 0.5%. So if it's lowered even more, there you have it. But that's typically what happens when the feds reduce interest rates. Yeah, the cost of borrowing goes down, which is great, but the costs or the interest rates on CDs and savings accounts are greatly reduced. But then it yields the question, well, as a regular old person, what am I supposed to do when the feds lower interest rates? Well, start by refinancing. So if you have a mortgage, you have an auto loan, you have a personal loan, even a home equity loan, you want to go to the bank, your financial institution, and talk to them about refinancing. That you talk to them about refinancing doesn't mean you have to. Typically, they will take a look at what the lower interest rates are. They will work up your payments or your particular situation and will tell you what your new monthly payments will be. Ideally, you want to be able to make a informed decision on whether the new reduced rates make that much of a difference on your monthly payments. But this is an opportunity to reduce the monthly payments on your mortgages and loans, and also for your credit cards. If you have credit cards where the interest rates are variable, And when you opened your credit card account, they should have sent you documentation that tells you about your interest rates. Or you can even call your credit card company and find out about that. But if your interest rate is variable, there is an opportunity that your interest the interest accumulating on your credit card balances will be reduced. It's not going away, but it is going to be reduced. You also want to consider a CD ladder. So last month and the month before, if you'd seen some of the updates I posted and you locked in a CD at 5% and 6% last month, congratulations, you're smiling right now. But the fact that rates are lower this month does not mean that an opportunity does not exist in CDs. You can stagger your CDs. So you want to take time to lock in longer term CDs before the banks start to adjust their interest rates, and then stagger that with midterm CDs and short-term CDs. So you want to have what that means is you want to park some money in 24-month CDs because the longer the CD term, the higher the interest rate. But you also don't want to lock in all your funds for a long period of time. So you want to consider a 12-month CD as well and consider a 6 month so that you have a mix of short term, mid-term, and long term. And if something happens in the short term to interest rates, you have that the funds in the short term CDs to take advantage of that, while also taking advantage of the higher interest rates that accompany CDs with longer terms. So that is something to consider. Now is also a good time to attack your debt balances. If interest rates are going down, especially on credit cards, if your APR, which will stay high, dips, there is a possibility it will dip. Now is the opportunity to start attacking your balances as much as you can so that you pay off the debt you owe as quickly as possible. If you've seen one of my previous videos, I've told you the interest on savings can never outpace the interest on debt. Like I mentioned, the average interest rate on a savings account is less than 0.5%. And on some specialty savings accounts, you might get up to 7 or 8%. But there isn't a credit card, there isn't a loan, there isn't a line of credit anywhere that offers you anything less than 19 to 20%. So the interest on your debt is always going to outpace the interest on your savings. Not saying don't save money, just saying if you can, attack your debt as much as possible so that you reduce that amount. And finally, just keep an eye out. If you invest, keep an eye out for stocks because now is usually when prices go up, the stock market is expecting an injection of funds into the economy, so prices typically go up. So if you are looking to sell, now might be a good time to see if you can make a profit on your stocks. And if you do need to take a loan, now is a good time because it's much easier to qualify now for personal loans and for business credit than ever before. So below, I am going to have a checklist just that will help serve as a reminder, something you can save somewhere, a checklist of things you can go through as you assess your finances and assess the impact of the federal rate cuts on your finances. As always, thank you so much for listening. Don't forget to like, don't forget to subscribe. And if you have any questions, if you come across anything interesting, more than happy to hear. Drop down in the comment section below. Go forth, as always, wishing you the very best in all that you do. And always remember, as you build wealth, to do so fearlessly.